It's time to buy T-Mobile. It used to be Verizon's communications word, but wireless now belongs to T-Mobile and its stocks will continue to benefit. Verizon was the undisputed winner of the 4G era, investing heavily in its network infrastructure and wireless spectrum license to build the nation's best service. Subscribers gained and premium price and wireless spoils. AT&T was hot on its heels, allowing management to splurge on the Sin's reverse foray into the media industry. T-Mobile and Sprint were laggard without the scale to compete with bigger players and forced to rely on discounted pricing to attract consumers to subpar networks. A lot has changed as the world has moved on to 5G. Nearly 2.5 years removed from its acquisition of Sprint, T-Mobile's business is humming. The once upstart wireless carrier is winning plaudits for its 5G network and gaining market share held by industry-low pricing for its mobile plans. Now, shareholders will benefit too as T-Mobile finishes the costliest stretch of its Sprint integration and gets ready to direct surplus cash flow towards buying back a significant portion of the shares. Now, it's difficult to overstate how much the shift to 5G has changed the competitive balance of the U.S. wireless business. The industry is in the early innings of a transition to next-generation networks, which deliver faster speed and better performance in crowded areas than earlier technologies through the use of more antennas, additional higher frequency airwaves, and greater network efficiencies. Now, the move has put T-Mobile in the pole position. T-Mobile's merger with Sprint, which closed in April 2020, has given the company an enviable portfolio of wireless spectrum licenses in the sweet spot for 5G. The greater operational network and consumer-based scale of the merged company means deeper pockets and more ammo for capital expenditures in the network. T-Mobile now has well over 100 million subscribers, leapfrogging AT&T. Its mid-band spectrum network covered 235 million Americans at the end of June and is committing almost $14 billion of capital expenditures this year, less than rivals but more than double its pre-merger rate. Now, unlike AT&T and Verizon, T-Mobile has managed to do all this without raising prices, and it has continued to see growth in average revenue per user, or ARPU. That's a function of consumers choosing T-Mobile's price tiers with more features, suggesting it's attracting higher value subscribers. It means T-Mobile can expand profit margin in coming years from some 4% this year, approaching Verizon and AT&T, which have mid-teens margin. Nowhere was T-Mobile's advantage more clear than during second quarter earnings season. T-Mobile trounced its rival, adding an industry-leading net 1.7 million postpaid customers, an all-important metric for wireless companies that refers to customers who pay a monthly bill, and beating Wall Street estimates on several key metrics. Management raised guidance across the board. Now, Verizon, meanwhile, barely matched expectations, lost postpaid phone subscribers, and cut its guidance for the second quarter in a row. AT&T saw strong subscriber addition but weak free cash flow as it spent on promotions to drive growth. It also cut full-year free cash flow guidance. Of course, a lot of this shift is already reflected in the shares. While T-Mobile stock has held its value over the past 12 months, nearly $147, Verizon is down 21% over the past year to around $43.50 per share, levels last seen in 2017. AT&T has slid 8% over the past year to around $18. T-Mobile stock goes for just 10 times enterprise value to next year's EBITDA versus around 7.5 times for its two rivals. Now, Verizon and AT&T are not sitting still. Both are also spending heavily on 5G, though both are at a spectrum license disadvantage. They were both spenders in last year's C-band auction, bidding a combined nearly $70 billion. That mid-band spectrum will be a key part of their 5G network, but it's only beginning to become more available this year and next. Meanwhile, independent analytics companies have consistently rated T-Mobile's 5G network ahead of Verizon's or AT&T's. Verizon management is confident that the full launch of the C-band spectrum and additional densification of their higher frequency millimeter wave network will close the 5G performance gap with T-Mobile. At the end of June, Verizon said it had 135 million Americans covered by C-band, rising to at least 175 million by the year end. We have a path to a very, very strong network performance, Verizon CFO Matt Ellis said on the company's second quarter earnings call in late July. Others like veteran telecom analyst Craig Moffett aren't so sure. Verizon has a history of excellence in their network operations, so it's certainly not something that one should dismiss out of hand, he says, but the physics are on T-Mobile's side. T-Mobile also has an attractive starting point on the side, supported by its 5G lead. Management is focused on growing market share in rural areas and among business consumers or customers, where T-Mobile and Sprint have historically lagged behind Verizon and AT&T. There's a long runway for subscribers growth there. Management expects T-Mobile's share of rural and business customers to rise to 20% by 2025 from the low teens and high single digits respectively. But the biggest boost to profit growth might come just from doing nothing. T-Mobile management said in July that they expect to be done with the Sprint network integration by the end of September versus a previous goal of the end of 2022. That has been the costliest portion of the acquisition integration, involving shifting sales side from one network to another, shutting down duplicated ones, and transitioning former Sprint subscribers to T-Mobile network. Merger-related costs were almost $1.7 billion in the second quarter alone. Now, once those costs are in the rear-view mirror, T-Mobile's increased customer scale and rising ARPU will flow through to free cash flow, opening the way for a massive share buyback program that could be announced later this year. Now, Deutsche Telekom owns 48.4% of shares, with SoftBank holding 3%. The remaining 48.6% of T-Mobile's tradable market capitalization is roughly $90 billion versus a potential $60 billion buyback program over 4 years for management guidance. That's huge. Now, retiring 2/3 of the stock's float would dramatically increase earnings per share. As a result, Wall Street analysts expect T-Mobile's earnings to grow fourfold from $2.41 in 2021 to $11.54 in 2025. Verizon's and AT&T's earnings per share are expected to be essentially flat from 2021 through 2025. So, forget T-Mobile's slight valuation premium over peers of its recent run. They barely begin to reflect its vastly superior growth trajectory and buyback plan. T-Mobile remains an investor's best bet in telecom.